our next guest, who is Craig Peckham over at Jeffries. And Craig has been, of course, closely watching the markets. And you say that, aside from all the factors that Suzanne just mentioned, I mean, the FOMC, Geithner, I mean, the FOMC is going to dominate in some ways for the markets, right? Yeah,
I think a couple of reasons here. If it were any other time of the month, I would say that the earnings would certainly dominate the focus here. But what we're going to have is wrapping up the trading day. I think we're going to have people squarely focused on what the statement language is going to look like at 2:15. Two elements that I think really bear watching are, number one, will we see the exceptionally low levels, quote, with respect to interest rates, and will we see an extended period reiterated with respect to the exceptionally accommodative monetary policy that's out there. Any change to those two elements, and I think that's something that will take the market by surprise. I do think it's probably important, though, to look at not just the FOMC meeting at 2:15, but I think we also need to probably move past this State of the Union address as well, because from a Wall Street perspective, I think some of the volatility that's been emanating from a policy standpoint out of Washington in the last 2 weeks has really been another factor here that's held on stocks.
Craig, let's go back to Fed, because cheap money is one of the reasons you had still been bullish on at least some stocks. So what is your gut telling you, and how are you going to react to what we hear from the Fed today?
Well, I think one of the things that we're getting from some of these forward-looking projections from corporate America is a message that clearly we're not out of the woods yet. We still have corporate America that's still somewhat reticent about committing new growth capital to their own businesses. I think that's largely representative of the kind of uncertain point in the cycle that we remain at. I think that's relevant for Fed policy in terms of dictating what the timing of their withdrawal is going to be. And I think what we have here now, still not enough information out there, not enough threat to the pricing front to justify taking away stimulus any faster than what people expect, which I think is looking like a 2H10 scenario at the earliest.
Hey, Craig, Adam, let me jump in here. 15 or 20 seconds. What are the key words to listen to tonight out of President Obama's speech?
Well, I think we want to look at taxes, number one. I think that's going to be a focal point. I also think we need to hear about jobs. At the end of the day, what really this marketplace is focused on is job creation, particularly as it pertains to consumer spending down the road.
Okay, but Craig, aside from all of these factors that we've been talking about, I don't know if you guys have been noticing too, but it seems as if risk aversion is creeping back into this market, despite all these factors we're talking about. But risk aversion is coming back. Does it not appear that way?
No, I think you're absolutely right. I think and one of the root causes of that risk aversion is that one of the global marketplaces that's I think most representative of willingness to take on risk has been exposure to Chinese markets. We've seen obviously
materials and technology, by the way, are two underperforming groups, underperforming the rest of the market this year.
And that largely falls into play. I think if you rattle off the sectors at which investors think about in terms of that risk on trade, you have to focus on those too.
Okay, Craig, we'll have to leave it there, but good for you to join us through the opening bell. That was Craig Peckham, equity trading strategist at Jeffries and Company.